Hey everybody, I'm Mike Krupa, and today we are going to talk about stop-loss insurance. Stop-loss insurance is what self-funded health plans put in place to be able to protect them and give them a worst-case scenario from a financial perspective. And there's two different types of stop-loss protection. There's individual stop-loss protection, and then there's aggregate stop-loss protection. We're going to review both of those. Today, we're going to focus on individual stop-loss coverage and what that means for employers. So first off, it's individual. It is going to protect your cash flow for every single individual on the health insurance plan, whether they are an employee, a spouse, or a child on your plan. And again, what it does is it provides a worst case scenario. And that worst case scenario is called your individual stop loss deductible. Why they chose deductible, I have no idea. But don't think of this like a deductible on your health insurance plan, like what the member pays. Think about this like your deductible as the employer. And in this example that we're going to walk through, this particular one has a stop loss deductible of $75,000. So again, what that means is that for every individual on the health insurance plan, the most that employer will pay in a 12-month period is $75,000. Caps your exposure. It is your worst case scenario. So let's just walk through these examples where the stop loss deductible is at 75. In this case, Mike had a $100,000 claim, Chris had a $125,000 claim, and Pat had a $162,500 claim. And so in each of those examples, the stop loss deductible at 75, well, the plan gets back 25 grand in this example, they get back 50 in this example, and 87.5 in this example. So that's your max exposure on those plans, $75,000. So let's talk about a couple contractual terms now that are important for individual stop loss coverage. First is your deductible. That's what we talked about. That is going to be your worst case scenario. And the deductible will vary depending on the employer, and a few different things that will cause that to vary. One, how big is the employer? Generally, smaller employers have a lower risk tolerance. Larger employers have a little bit bigger of a risk tolerance because healthcare gets more predictable the more number of people that you have on the plan. So this deductible can vary. It's generally smaller for small employers and larger for large employers, but that's super important to know. The next one is something called your contract terms. This dictates the claim, when it was incurred and when it was paid, and when the stop loss policy will actually cover it. So let me just walk you through this real quick. In this example, we have something called a 12/18 contract. The first number represents when the claim was incurred. When did you go into the hospital? When did you go see the doctor? That is when it was incurred. The next one is when was the claim paid? When did the provider actually receive the payment, right? Think about like a member goes into the doctor, they probably don't get the bill for a couple months later. So we want to know what this stop loss policy is covering. You know, and generally there's a lot of employers that are on, a calendar year basis. They start their policy on 1/1. It goes through 12/31. And in this example, I'm going to put on June 30th of the following year, and I'll show you why. Because what a 12/18 stop loss contract covers is anybody that had a healthcare event in this 12-month period, January through December, but then that provider was paid anytime within 18 months. So all the way from January through the end of the following June. And this is super important because you could get a 12/18, you could get a 12/15, a 15/12, an 18/12, a paid and incurred contract. There's all different types, and some are more appropriate for certain employers depending on a lot of different factors. So keep that in mind. One thing that gets a lot of attention in an individual stop loss contract is something called a laser. And so with a laser, here's what happens. Best way to talk through it is an example. Hey, we know Mike Krupa, he's taking a medication and it costs $150,000 a year. And it's ongoing. He's going to be taking this for the foreseeable future. So because we know that risk, we're going to laser in on Mike, and we're not going to give him a $75,000 deductible for your exposure. We're going to give them, or Mike, a $150,000 stop loss deductible. So you are going to owe potentially an extra $75,000 on that individual, meaning now that is your liability, is $150,000 as the employer. And I've seen lasers at $600,000. I've seen lasers at $1.2 million. I've seen employers that didn't even know they had a laser on their contract when I took them over as their broker. This is something to pay a ton of attention to on your stop loss contract, because it is also probably the single biggest reason I have seen employers say they didn't have a good experience self-funding. It was because they had a laser on their plan that they didn't know about. Going into the next provision, it actually just ties right into this. It's actually called a no new laser rate cap provision. And what that means is that at the renewal, the stop loss carrier cannot put on any new lasers. They will when you go to them for the first time when you're establishing a contract. But then at renewal, if you have this provision in there, they can't laser. But now think of it. If they know that they can't laser a known risk, what are they probably going to do? Well, they're probably just going to build that risk into the premium and make the premium you pay every month higher. So it's key when you get a no new laser provision, you also couple it with a rate cap. And the most common rate cap is typically a 50% rate cap, but it varies anywhere from, I'd say, 30% all the way up to about 60% is what I see most common in the marketplace. So this is a good way employers can help provide a worst case scenario for the second year in their stop loss renewal, right? Your first year is that deductible, but let's protect ourselves in year two. And again, this is a provision that's not right for all employers, but generally it can fit quite a few. Next is called specific advanced funding. This is crucial for smaller employers. And for sake of this conversation, I'm going to say employers less than, call it 200 employees on the health insurance plan. And basically what this does, take our biggest claim we have here. Basically what this does is instead of you, the employer, having to fund this entire $162,000 up front, because let's just pretend that was one claim, what it's going to do is the stop loss carrier is actually going to fund this portion for you. So you are only liable for the $75,000. You don't have to fund this and wait for a reimbursement. They do it for you. That is key from a cash flow perspective. And then the last one is this terminal liability. This is probably set up more so for employers if they are ever considering going back to a fully insured health plan. And that could be for a variety of different reasons. But if that's the case, and that could be you, you're going to want to make sure you talk with your broker about what is terminal liability and what does it cover. Because a lot of these things, if not set up correctly, can end up being the pitfall for a self-funded employer. So this is individual stop loss protection. Next, we're going to talk about aggregate stop loss protection, but I hope you find this information in this video helpful. And if you have any questions, feel free to reach out to me directly. Thanks.